When an attempted coup in somewhere as important as Turkey fails to dent investor sentiment, it's a sign that fundamentals aren't really the main market driver. Asia's emerging economies on Monday largely shrugged off Turkey's crisis in favour of extending last week's rally. Call it not so much a sign of risk on as nothing else on. Turkey's turmoil, with its implications for regional stability, should have rattled Asia, which had closed when the news broke on Friday. The fact it hasn't, at least at the moment, speaks more to investor desperation for a trend of any kind, in this case a search for yield. Within the emerging universe, Asia is the region most likely to gain, whether or not those gains are justified. And since it accounts for almost 2/3 of the MSCI's Emerging Markets Index, the sector benchmark, continued gains in the region will help lift the sector and cushion any fallout from Turkey. Asia's advantages include strong growth rates, relative political stability, and a general lack of commodity exposure. Monetary policy is on investors' side too. Last week, Malaysia unexpectedly cut interest rates, and Bank Indonesia could well follow suit this week. But peel away the headline numbers, and the picture looks far weaker. The export-reliant region is undergoing an unprecedented second year of trade recession, which could well extend into a third year. Most real economies are also contending with combined household and corporate debt to GDP ratios at or near record levels. Now, that limited headroom for the private sector leaves growth largely dependent on monetary or fiscal stimulus. In Asia, both have room to run. Now, that's an advantage over most of the developed world, but it's hardly cause for cheer. Long-term investors would, or at least should, take a growth-based rally over a debt-fueled one any day. But at the moment, they don't really have much choice.